The US economy is in big trouble. We didn't say it, someone else did. But who? Ray Dalio, a well-known investor, recently shared his concerns about America's economic challenges. According to him, things might take a turn for the worse due to a debt crisis and an impending balance sheet recession. Speaking at the Bloomberg Invest conference in New York, Dalio, who established Bridgewater Associates in 1975, emphasized the risky situation the U.S. economy currently finds itself in. And it will only get worse. If you don't remember the Great Depression of 1929, you must surely have heard about the Great Recession of 2007. During these recessions, the United States suffered economic losses like never before. And guess what? It affected the entire world as well. The question now is Ray Dalio trying to warn us about another Great Recession, or are these the words of a paranoid man? Before we get going, hit that subscribe button first. Done? Let's get into the mix of things. We're going to have a debt crisis in this country, were the words of Ray Dalio, uttered while addressing the press back in 2023. And honestly, it seems so. Dalio's belief is that the debt market is on the edge, waiting to see if there will be enough buyers for the upcoming surge in Treasury bonds. The seasoned investor explained that the dynamics of supply and demand will become more evident in the coming 1 to 2 years. There's a lot of debt. It has to be bought, and it has to offer a high enough interest rate, Dalio emphasized. However, he cautions that if the current trajectory persists, the balancing act in the next 5 to 10 years could become increasingly challenging. Okay, it all looks like a lot of mumbo-jumbo, right? Let's make it easier. The COVID-19 pandemic has disrupted the established order of the world. Despite increasing vaccination rates and efforts to combat the Delta variant, the job market is slow to return to normal, with U.S. unemployment stubbornly above 5%. The reality is that the United States is still squarely in the midst of a pandemic that has the potential to permanently reshape the way we work. And that's where the majority of the problem lies. Well, sort of. There are 3 major concerns facing the U.S. economy as it is now. Let's analyze them. The first problem has to do with wages. They're simply not enough. The truth is, the U.S. economy has been grappling with labor shortages since the onset of the pandemic. Many workers retired, while others were laid off, prompting a reassessment of their job priorities. Some chose to forego second or third jobs, opting for alternative pursuits like caring for grandchildren or adjusting their lifestyles to cope with financial losses. In response, major retailers such as Amazon and Walmart are offering lucrative signing bonuses and financial incentives, making it challenging for smaller businesses to compete for workers. The pandemic has also accelerated the adoption of remote work, with some employers using it as a hiring incentive. While this option suits office workers, not all roles can be remote. Despite its convenience, remote work has led to record rates of burnout, and corporations face financial losses with vacant facilities. Companies like Apple and Google are encouraging on-site work through perks, but smaller businesses lack the resources for similar strategies. So while big businesses enjoy the power over labor, small companies, who literally drive the economy, suffer for it. And that brings us to our next problem. But before we get into that, we hope you're subscribed already. Yes? Okay, let's go. The next problem facing the American economy is the age demographic. This is a very simple concept, and we won't really spend much time trying to explain it. Now, the current workforce shortage can be traced back to fundamental demographic factors. The baby boomer generation, being over 3 times larger than the preceding silent generation, significantly boosted labor force participation when they entered the workforce in the early 1960s. Good, right? However, the subsequent Generation X was smaller in comparison to the boomers. The millennial generation, while slightly larger than the boomers, and Gen Z, slightly smaller than millennials, created a demographic gap. In an ideal scenario for economic growth, each succeeding generation should be larger than its predecessor, forming a triangular pattern. Unfortunately, reality resembles an inverted triangle. This demographic shortfall poses challenges for the workforce. As boomers retire and leave the workforce, there aren't enough younger workers to fully replace them. Despite boomers continuing to contribute to consumption and spending, businesses must navigate this shift with a smaller pool of workers. And we know how Gen Zs spend a lot of their time these days, don't we? So the lesser the workforce, the more jobs will suffer. And finally, the real problem Ray Dalio talked about, the most bothersome problem facing the United States: debts. America's growing debt is the result of simple math. Each year there is a mismatch between spending and revenues. When the federal government spends more than it takes in, we have to borrow money to cover that annual deficit. and each year's deficit adds to our growing national debt. Historically, our largest deficits were caused by increased spending around national emergencies like major wars or the Great Depression. Today, our deficits are caused mainly by predictable structural factors: our aging baby boom generation, rising healthcare costs, and a tax system that doesn't bring in enough money to pay for what the government has promised its citizens. We pretty much covered all of these, right? Well, it gets better from here. So we know the coronavirus crisis has accelerated an already unsustainable fiscal trajectory, both because of its devastating effect on the economy and the necessary legislative response. Our society is getting older, thanks to the big wave of baby boomers retiring, like 10,000 of them hitting the big 65 every single day until 2030. Plus, people are living longer, which is awesome, but also means we've got to figure out how to handle the financial side of longer retirements. These big shifts are putting more and more pressure on the federal budget, especially on crucial programs for older folks and those who need a bit more support, like Social Security, Medicare, and Medicaid. One key area feeling the heat is healthcare, and it's a big deal for our country's money matters. It's nearly 20% of our entire economy and is the second fastest growing budget chunk. Now, here's the kicker. We're splurging on the US healthcare system, making it the priciest in the world. But guess what? We're not exactly getting our money's worth. We're shelling out double the cash compared to other advanced nations, but our health outcomes aren't any better. Fixing up the US healthcare system isn't just about making lives better, it's also about keeping our financial ship steady. It would be a different story if our tax code was all set to handle the promises we're throwing around. Spoiler alert, it's not. The US tax system isn't bringing in enough money to cover all the spending our decision makers are signing off on. This growing gap between what we're bringing in and what we're spending leads to bigger and bigger deficits every year. And the end result? A national debt that just keeps on climbing. Okay, so we're back to Ray Dalio's concerns. America's taking too much. These debts are getting too much, and they will sink the American economy. But here's a huge question we should really answer. How did the debts get this much? We have an easy answer. Hold on, have you hit that subscribe button yet? Come on, let's get that done. Now, since the early days of the United States, we've been in the habit of running annual deficits, basically spending more moolah than the Treasury Department scoops up in taxes. It's been a recurring theme since the nation's birth. Let's get our terms straight. The deficit is a year-to-year thing, while debt is the grand total of what the government owes. Now, the cool way to measure both is as a chunk of the GDP, which takes into account inflation, population growth, and changes in per capita income. Fast forward to the end of World War II, and the US was flexing its muscles as a global powerhouse. But here's the plot twist. Defense spending during the war meant a ton of borrowing, pushing the debt to a mind-boggling 100% of GDP in 1946. Over the next 3 decades, though, economic growth did its magic, chipping away at the debt even with expensive wars in Korea and Vietnam and the birth of big entitlement programs like Medicare and Medicaid. The debt hit rock bottom in 1974, chilling at a cool 24% of GDP. Then the 80s rolled in with the Ronald Reagan show, featuring a blockbuster of defense spending and epic tax cuts. Surprise, surprise, the debt started climbing again. The 90s had a different vibe, with a combo of tax hikes, defense trims, and a sweet economic boom, shrinking the debt as a percentage of GDP. Cue President Bill Clinton and a Republican Congress pulling off a 4-year budget surplus streak in 1998, the first in 4 decades. But the deficit drama wasn't over. President George W. Bush swung in with tax cuts, war spending in Afghanistan and Iraq, and flashy new entitlements like Medicare Part D. Annual deficits shot up to over $1 trillion. Then came President Barack Obama, dealing with the fallout of the Great Recession. He kept the Bush administration's bank bailout plan and pumped hundreds of billions into fiscal stimulus, sending deficits to record highs. And there you have it, more debts. Right now, the debts are well over $30 trillion. Yeah, you heard that right, $30 trillion. You're probably wondering what all that money is used for, right? Let's dive into the federal budget, where the money dance happens in 3 main categories: mandatory spending, discretionary spending, and interest payments on the debt. Now, most of the budget boogies its way into mandatory spending, kind of like a recurring party. You don't need an invite. It's automatic unless Congress decides to shake out the legislation. Social Security, Medicare, and Medicaid are the stars of this show, gobbling up the largest share. On the flip side, we've got discretionary spending. This is the Congress-approved section, and they have to give it a nod each year through the appropriations process. In 2022, only 27% of the federal spending party was reserved for discretionary programs. Defense hogged the spotlight, snagging about $750 billion, while other VIPs like health, education, veterans benefits, and transportation got less than $150 billion each. Now, if we peek into the future with the Nonpartisan Congressional Budget Office, or CBO, they're pointing fingers at the big spenders: Social Security, the kingpin of U.S. government programs, along with Medicare and Medicaid. The CBO predicts their costs will rise as a percentage of GDP, especially with the U.S. population gracefully aging and health expenses strutting their stuff without a matching increase in revenue. Hold on, though, we've got another player on the scene: interest payments on the debt. In the immediate future, these payments are gearing up for a dramatic increase in relation to GDP. Thanks to the Federal Reserve tapping the brakes on inflation caused by the pandemic and the Russian invasion of Ukraine, interest payments hit a two-decade high in fiscal year 2023 at $659 billion, making up about 2.5% of GDP. Brace yourselves, they're projected to hit almost 7.5% over the next 3 decades. On the flip side, discretionary spending, the cool cat of the budget, is expected to keep its groove and stay constant as a share of GDP. The end result? An economic disaster that no one wants to have. And that is exactly what Ray Dalio warns about. And there you have it, Ray Dalio's warnings about the spending habits of the United States and how it could be a possible disaster. Hey, why don't you check out our other videos on economy, finance, and business? You'll love them. We'll catch you in the next video.